India recently boasted a noteworthy accomplishment since the country became a member of the JP Morgan GBI-EM Global Series Bond Index. It is expected that this development will have a wide-ranging favorable impact on India's financial markets and economy. Now let's analyze what this implies and why is this important. Firstly, what is a bond index? Similar to index of stocks, a bond index is made up of bonds organized according to the issuer, credit rating, and bond term. It assesses the efficiency of a particular segment of the bond market. And through relativity of price changes and sometimes on the interest, they mirror how the segment performs. Bonds are also positioned as benchmarks to compare the investments as well as through passive management by buying index funds. What is in effect the JP Morgan GBI Global Series Bond Index? The JP Morgan GBI Bond Index is a benchmark that tracks the performance of bonds issued by the emerging market countries. Being a part of this index means that Indian bonds will now be included in a widely followed investment tool used by global investors. The inclusion is expected to attract significant capital flows into India's bond market with estimates ranging from $25 to $30 billion. Other implication apart from this inflow is of the $25-30 billion is that followed by these funds, there will be more other funds from other investors which will be coming into the capital markets, the bond markets as well as the equity markets. And this can be invested by India to make better infrastructure for businesses. The borrowing costs will be lowered. It will decrease because typically if the demand of bond increases, the yield will decrease. Currency will strengthen. When the foreign investors buy Indian bonds, they will have to buy Indian rupees to do so. The increased demand for the rupee can lead to its appreciation or at least arrest the depreciation of the Indian rupee against the US dollar. A stronger rupee can have several positive effects, including making imports cheaper and reducing inflationary pressures. The market confidence. Getting into such a large global index like the JP Morgan Bond Index paves the way to enter into other indices of bonds. Also, it gives a confidence to the global financial institutions to invest more in India, in debt as well as equity markets. All in all, a big positive for the Indian equity markets.